Hey, thanks for tuning in to watch our 2014 crop year update for KW Insurance. We'll now be handling deadline meetings by appointment only through our office, so please call and set up a date and time you'd like to meet with us. If you were unable to make the meeting, or if you'd just like to come in and talk through your operation, please give us a call so we can schedule a time for you. That'll allow us to set things up ahead of time, mostly for your convenience so that you're not sitting here waiting. We have 4 new offices now added to our office building, which provided more privacy for our customers and obviously a lot more space too for us to work in here. So feel free to stop by anytime to see the new office setup. We'd love to have you. This also provides separation from our chemical business, which is nice during the busy times at least, so that we can focus on the crop insurance on this end of the building. And we increased our access to our home, auto, and farm companies. In the past, we hadn't really pushed this area of our business very much, but it has grown quite a lot in the last couple of years. And now our new alliance through Pacific Crest will give us access to all of these new companies. As you can see, we have a pretty broad selection now of companies that will have direct access which will actually provide us opportunity to more actively service you guys, because we'll have direct access through the underwriters. So if you want a quote on home, auto, farm policy, life insurance, please give us a call. We'd love to go through that with you. Just in summary, again, that gives us direct access to the carriers. We have access to more markets than we had in the past. And also, pretty soon through our website, you'll be able to click on a link. And if you want a simple quote like a home or auto, you can go in there and enter all your information for us right on that website, which will speed the quoting process up on our end. And then we'll be sure to take that information and plug it through a bunch of different companies to give you the best quote that we possibly can. Life insurance, we're now licensed to sell life insurance as part of our new product mix. Laura is the life insurance agent in our office, so if you have any interest in that, you can get a hold of any of us here, but Laura will be the one that you'll work with on that. So going forward, here's the main object of this meeting anyways, are the multi-peril updates. One of the things that changed in 2014 is that chickpeas are now insurable in Toole and Glacier counties. That's a change from last year where those had to be a written agreement before. The Farm Bill passed, which is a positive thing for everyone here, and most of the beginning of this presentation is going to cover some of those changes in the 2014 Farm Bill. The bigger changes coming in 2015 in the new Farm Bill for crop insurance. Most of the changes that will take effect before that point will actually be on the FSA side. All the changes going forward, crop insurance wise, will start in 2015. Here's just a quick graph showing you spending comparisons in each Farm Bill. Or in this Farm Bill in the budget. As you can see, nutrition spending still is a huge chunk of it, and that our commodity conservation and livestock spending, the actual agricultural part of the Farm Bill, is pretty minimal. Here's some changes. First one, big one probably for all of us, is that direct payments are now eliminated, so you won't be receiving that direct payment check every year from the FSA. You're going to have to fall into either a disaster or get signed up in some sort of a NRCS conservation program to start getting payments through the FSA anymore. Now, enterprise units are made permanent, which is a positive thing for the crop insurance. It was a pilot program before this bill, and we increased subsidies for beginning farmers on the crop insurance side of things. So if you farm for 5 years or less, actively farmed or ran a livestock operation for less than 5 years, then now your subsidies will increase by 10% on your crop insurance premium, or effectively it will result in a 10% discount for the beginning farmer's crop insurance premium. And you also have the opportunity to possibly use yields for the person you're taking the land over from, even if it's a cash lease, and possibly have a better starting yield than the county average going forward. Conservation compliance, this is one kind of big part of this Farm Bill too, is that if you fall out of compliance on the conservation end of things at the FSA, they'll actually cut your crop insurance subsidies out as well, which would effectively at least double your crop insurance premium. So, and the other thing is plowing native sod is something they're really going to discourage going forward in this Farm Bill. If you do that, your subsidy will be cut in half on that land that you broke out for the sod, so your premium will be a lot more just for that land. And then for the first 4 years, you'll only get 65% of the county average for the new breaking on that. Another thing in the Farm Bill, yields for a crop year in which the entire county is below 50% of the 10-year average can now be excluded from the producer's history. So what does that mean to you? Those bad drought years back in 2000, 2001 that plug zeros on our yields, we could actually effectively go now and take out of your history, which would be a major benefit going forward as we get into other drought situations as well. Basically, we get into years where we just don't have a crop and it's kind of a county-wide type of thing. They're going to let us just remove those from our crop insurance history completely. So very positive thing going forward. Irrigated and dry land, you'll be able to pick different insurance levels on now. So you could have 70% on your dry land wheat and only 50% on the irrigated if you wanted. SEO is the new disaster program that you'll be able to buy through us here on the federal crop side. You only qualify for that if you pick the PLC program at the FSA, which is one of the 2 disaster programs you'll have the opportunity to sign up for. It's subsidized at 65% of the premium, so pretty close to what your other crop insurance is. And it covers the gap between whatever level you pick. So if you pick 70% on your crop insurance side, if we fall into a disaster, this would pay you the difference between the 70% and 86% of your yields on your units. There's no payment cap on this program, which is another positive, as there would be at the FSA on their programs. So if you're an individual, you'd be capped out at $125,000 on the FSA side of the disaster programs. On this program, there would be no cap. And it would pay on the acres you have seeded, not off your base acres. So SEO coverage option, this is just an example slide. It basically shows you over here, if you have a deductible, if you had a guarantee on your crop insurance of 150 bushels, this is obviously corn that this is based off of, and we had a $5 bushel price, so you'd take the 50% level, so we'd take your $750 an acre, which is the 150 bushel coverage, times the $5 price would give us $750 times the 50% level you pick. So on your crop insurance, you'd be guaranteed $375 an acre in this example, or 50% coverage. As we go over to the the other side of this, the disaster side, the SEO policy then would cover the difference between the 50% and the 86% for this unit. So in this corn example, your SEO potential payment to be $252 an acre if this county fell into a disaster. Now this is not if each unit falls underneath a certain yield level. The whole county has to fall underneath 86% of the county average before this starts to trigger. So this is based on county-wide yields, not on your individual farm yields, but it's going to pay off of your individual farm yields. Some other things with this crop disaster program, between the choice of PLC and ARC, which we'll get into a little bit later in this presentation, you're going to have to pick one or the other for each crop on your farm, and once that choice is made, you have to stick with it for 5 years or through this next farm bill, basically. It's a permanent election. If you don't choose anything for 2014, you'll automatically be enrolled in PLC going forward, and you won't be qualified for any payment in 2014 or retroactively. So just some new stuff on the new farm bill. I'm not going to spend a whole bunch of time on this because they haven't written all the rules on it yet, and you're not even going to be able to choose these programs until this fall. So there's going to be a whole bunch of stuff that's going to have to be determined between now and then, and as far as you having to learn it all right away, obviously there's no sense getting in a hurry on that end of things if you're not going to be able to choose till at least August at the FSA. So what changed? Direct payments, like we said, were removed. They removed the counter-cyclical program, or the one that was a price-triggered type of program. They took away the acre and the SURE programs, which are the 2 disaster options they had in the previous farm bill. And they've extended all the current loan programs at their loan rates. And they extended the SURE program for livestock, trees, bees, and fish, retroactive back to 2012. And this is the big one that we're going to go through just a little bit here, but they created 2 new disaster programs, one called price loss coverage, which is PLC, and one which is ag risk coverage, which is ARC, which is a revenue and yield loss program. So it's one-time choice, like we just said, of either PLC or ARC. If you choose ARC, you have a one-time choice of either doing the individual ARC, which would be based on your farm yields and income, or the county level ARC, which would be based on the county's yields and their Olympic price set for the wheat. So individual whole farm ARC program, basically your benchmark revenue is the sum of your most recent 5-year Olympic average revenues for all program crops on the farm. The national average PLC price will be used to figure the price for this program. Like I said, I'm not going to get too in depth into this stuff, but basically it'll guarantee you that if your whole farm falls below 86% of a benchmark revenue and the whole county falls into a disaster, that your payments will be triggered off of your farm yields and not off of a county indicated yield. The only problem with this program is, granted, it will reflect better what will happen on your individual farm, but it only pays on 65% of the base acres. You'll see if you use the countywide ARC, if that's the direction you decide to go, you actually get paid on 85% of your base acres instead. So it's debatable which one would be better. There's going to be all kinds of calculators out here pretty soon to look through this, but this is just to give you just a quick rundown on what the options are. The county level, that's the one that we're referring to, that would pay if the whole county fell below a certain yield level, and then it'll pay you off of whatever the county yield comes back, not what actually happened on your farm. But the good thing about this one is that it pays on 85% of the base acres, not just 65. So it could be a substantial difference in the potential payment once it triggers. And the payments are made up to the end of the marketing year on all of these programs. The tricky thing with that is that the FSA's marketing year, like for 2014, would actually end in June of 2015. So that means that disaster payments at the soonest could be paid out in June of the following year after the disaster happens, more than likely a year and a half or so from the actual disaster time. The PLC program, this actually is a program that has nothing to do with the yields in the county, but only triggers if the grain market falls below these price triggers listed on the sheet here. So you can see the wheat is set at $5.50 a bushel. And that price is all wheats figured together, which would be spring wheat, winter wheat, durum, everything is figured and weighted somehow into this average that the government comes up with. Barley, the same thing. You look at that and you say $4.95 a bushel, that looks really good. Well, it does, except that figures malt and feed together. So, for instance, this year, even though feed really tanked, the Olympic average of barley total came out at like $6 a bushel because of all the malt and how good the contracts were. So when we first looked at this, we thought that maybe barley would trigger a payment every year if that was set that high, but you have to remember that it's weighted between malt and feed. Now, the one other thing to consider on here is peas, which are like at $5.50 a bushel, and those are kind of the main crops, I guess, that we would deal with. Basically, your payment is triggered by the difference between these reference prices and what the market year average is for the price in the county. So when they get the NAS data all back and the market year is complete, which would be, like I said, June of the next year, if wheat ended up at $4.50 a bushel average for that crop year, you'd get $1 a bushel payment. The difference between $5.50 a bushel up here and the $4.50 that they figured, times whatever 85% of your base acres, then times your farm-wide average or whatever for that crop on your farm. So I know this is really confusing. I just wanted to give you a feel for the fact that one of them is kind of a revenue yield-based program, and then the other one is based just strictly off of the fact if there's average price or strike price or whatever falls below the levels that they have set here, that's where your payments will be triggered. The one thing for with signing up for this PLC coverage, though, is that you would qualify then to purchase our SEO coverage through the crop insurance, which I think going forward probably is going to be a pretty good option, but like I said, we won't know till this fall. One more thing with your base acres, you'll have the one-time option here to either retain your base acres or reallocate the existing base acres. If you wanted to reallocate them, that means that they would take your cropping records from 2009 through 2012 and reproportion your acres as far as whatever percent of crop you had seeded to each variety or whatever on your farm in those years. You can never raise your base acres. That's we checked with that with the FSA, thinking with all the extra recropping we're doing now and everything that we might actually be able to raise our base. That's not the case. We can only just reallocate base. So here's your payment limits, like we talked about: $125,000 for an individual, $250,000 for a spouse if the spouse is also actively involved in the farm, from what I understand. And you're going to redefine what actively engaged in farming is as far as who would be eligible for these disaster payments or LDPs or loan programs. So someone who's far removed from the farming operation, like a second cousin that just happens to have a share in your corporation, they probably won't be eligible for payments anymore. There's one single adjusted gross income cap over all the programs now at the FSA of $900,000. On the conservation side, they're going to whittle down the acres of CRP just a little bit more. They're going to consolidate 23 NRCS and FSA programs together into 13. And the CSP program now, they want to enroll 10 million new acres per year from 2014 through 2022. So they're going to become more aggressive on the funding, or that'll sort of be your subsidy payment now is going to come through conservation end of things, and not so much obviously through direct payments since they did away with those. Just a slight decrease in EQIP funding, but it sounds like that program will still be funded for some of the new projects like cover crops or laying water lines into pastures. This is just a flow chart that explains basically your options with the new commodity title, whether you sign up for ARC or PLC. And then you can go down through there, and on either one you'll have the chance to either use your old base acres or reallocate them. And then on ARC you can choose either individual or county average that they're going to use to figure your payments. And also on the PLC you can choose whether you want to update your program yield or retain the old stuff. If you do PLC, as you see at the bottom of the chart down here, that also qualifies you to purchase SEO from Federal Crop. A few more changes. Some of these happened a couple of years ago, but basically we went from $100,000 to $200,000 per loss. That's on a crop per county basis before a 3-year APH review must be done on your crop insurance. So if you have $150,000 loss on wheat and $150,000 loss on barley in your county, you still wouldn't be triggered for an audit because those crops aren't hitting the $200,000 mark. That's a positive thing with the high liabilities, especially as the commodity prices were up. So all acreage will be reported on map-based forms to the field level. That we've been doing for a couple of years now, but it's really increased our accuracy, I think, of our acreage reporting process, as you guys will see maps sent back to you all the time of what we input that you can visually double check and not have to just look through a bunch of lines of data. And then new breaking now can be approved through our office in Missoula, the NAU office, instead of the government in most cases, as long as it's under 320 acres. So if you're going to do any new breaking, we need to know about that soon, like before this March 15th deadline, so we can determine whether we can insure it through NAU or we need to send it off to the government. What do I need to do this spring? Obviously pick programs and levels. Pick a unit structure for each crop. We'll go through enterprise and optional units going forward in here, and then review all your crops and levels on your apps. And of course, sign your application and get it back to us by March 15th. Oh, this is a funny little slide I just put in here that kind of reminded me of farmers around here sometimes. Here's some dinosaurs sitting on a rock and the Noah's Ark's floating away, and they said, oh crap, was that today? So try not to be that producer, waiting till the deadline to get this stuff done, as it greatly increases our chance for having problems here. Here's your base prices for 2014. When I did this presentation, a few of these were estimates, but I'll take you through the things that may have changed here. Winter wheat was set last fall at $7.11 a bushel. That's while the market was still up, so that's good. Spring wheat is the February average of the September futures, the Minneapolis September futures. That actually came in at $6.51 at the end here. This slide says $6.50, but that's close. Same thing with Durham. That means that would come in at $7.24 instead of $7.23. Durham is just figured off of a percentage of the spring wheat price. So they figure the spring wheat base and then take it sometimes times 1.1, let's say, whatever factor they come up with for Durham, and that's how they would get that price. The barley base price went down a lot from last year. That was $5.24 a bushel. As you'll see here now, it's at $4.03. That's all because that's based off the corn futures market. So as corn dropped, barley drops in step with it, and this base price is just based off a percentage of the September corn futures in the Chicago Board of Trade. Canola also dropped off from like 24 cents last year down to 18, for obvious reasons, because that market as well has declined. And then the green and yellow peas down here, I had estimated this price at 14 cents. There's no way to really track that till they release it, but it actually came in at 16 cents a pound, which is $9.50 a bushel. So that was a real positive thing for some of you pea growers, that the guarantees are going to be higher even than what we were banking on that stuff. And then lentils, they were estimated at 19 cents a pound, and I believe that's actually where they came in at the end here. So what are your options for your multi-barrel crop insurance? Obviously you have revenue and yield protection that you can pick between. almost no one does yield protection anymore unless you want to insure like the contract price of a specialty crop like waxy barley. Almost always revenue protection is going to be your best bet just because of how volatile the markets are. So how does revenue protection work? We always try and go through this with you guys, but in the spring, this is just an example that we're going to go through what happens when the price declines with revenue protection. So in the spring, let's say you have a base price of $10 a bushel at seeding time, and you're guaranteed 28 bushels in acres.